referring to you now the concept of duty remission schemes. Under that, we already understood all industry duty drawback, bond rate of duty drawback under section 75 of the customs. If all industry duty drawback amount less than 80% of the duty already suffered by me being an exporter, then for the exporter, special bond rate is applicable. Minimum 1% on FOB value of export is duty drawback. Maximum 33% of the FOB value of export duty drawback. Section 75. Make in India. After manufacture in India, I am exporting the goods. In that case, eligible to claim duty drawback benefit. I am not talking about section 74 of the Customs Act 1962, where what I imported the goods, same exporting back without any manufacture, then there is no incentive at all. It is not incentive. Whatever duty drawback what I claiming of duty paid by me earlier stage is not an incentive scheme. Incentives, export promotions under foreign trade policy 2023 is section 75 duty drawback of the Customs Act 1962, which is all industry drawback rate, if not special bond rate. Otherwise, altogether different duty drawback called as bond rate. These points already we referred with regard to duty drawback. Now coming to this particular point, remission of duties and taxes on exported product, namely the RODTEPS. What is this scheme talks about? Earlier, we had merchandise export from India scheme, service export from India scheme, like that. Now, remission of duties and taxes on exported product covering all type of taxes and duties you suffered at the state level as well as central level. All clubbed together, you can ask for incentive of the duty taxes you suffered. Earlier, the scheme of MEIS, SCIS, central level taxes only, central level duties only. Now, the remission of duties and taxes on exported product is covered broadly. The exporter who suffered earlier the state level taxes, even like entry tax, outright tax, that tax, this tax, followed by central taxes, duties suffered, the remission of duties and taxes covering all this and giving the incentive in terms of percentage on FOB value of export. What is the percentage of duty drawback I can get here? Means there may be 2%, 3%, 5%, depends upon the country where I exported, depends upon the product which I exported. Duty credit script it is. But this scheme is also post-export benefit. Post-export benefit. Even if I suffered GST taxes, also be covered here as incentive. Now, having this particular remission of duties and taxes on exported product duty kit script, what benefit I will get? I can set off this particular duty script amount against import, where I am going to pay import duty, basic custom duty. Against that, I can able to set off this. But I cannot use this particular remission of duties and taxes to set up IGST payment on imports. This duty kit script also negotiable instrument which is transferable. This particular remission of duties and taxes on exported product is also be granting to special economic zone units. Sir, special economic zone units not going to pay any duty on account of import or export, no sir. Then what they will do with that particular remission of duties and taxes on export product? They can sell off that to somebody else who are going to import the goods To the extent of the duty credit scrip amount, they are not going to be paid basic custom duty on their import. Thereby they get benefit. So this can be sold on discount basis. If the duty credit scrip is 5 lakh rupees, means the buyer won't purchase at 5 lakhs. He will ask discount. You sell 3 lakhs, you sell at 4 lakhs. Then I bargain with the buyer and I sold, being a SEZ unit, my duty credit scrip at rupees 4 lakhs. The value of scrip how much? 5 lakhs. I am getting cash 4 lakhs, being a SEZ unit, as a helping hand to the SEZ unit, and the buyer of that particular scrip going to import the goods where he is not going to pay basic custom duty to the extent of 5 lakhs the scrip value. Thereby he got the benefit of 1 lakh. Is the way in which the benefit takes place. On account of sale of this particular remission of duties and taxes and export product scrip, attract the IGST, supply of goods. Now, this particular duty credit scrip under this particular remission of duties and taxes on exported product is how long valid once it is issued to the exporter after export? For a period of 24 months valid. Remission of duties and taxes on exported product is valid for a period of 24 months, within which he can import the goods to set off the scrip value against payment of BCD, or it can be transferred to somebody else to encash the amount. Now, in the given case, duty credit scrip, how will be calculating? FOB value of exported product or 1.5 times of the market value of the product, whichever is less. On such value, percentage of duty credit scrip applies. What do you mean this? How to understand this? The right sentence here is duty credit scrip as a percentage on what value? Earlier I mentioned duty credit scrip is equal to what? The FOB value of export or 1.5 times of the market price of such product, among whichever is less, on which apply the duty particular scrip as incentive. 2%, 3%, 5% slab rates are there. In that case, the right word to write here and understand is duty credit scrip as a percentage on what value? FOB value of export or 1.5 times of the product market value, among the two whichever is less. How to identify this? With the help of numeric example I am bringing to this, one can able to understand just by reading itself. Questions are going to come in this regard in the exam also. So presenting here example on remission of duties and taxes on exported products. During the financial year 23-24, Messrs. Yes Private Limited has made export of safety valves coming under the chapter heading 8481, country of export USA and UK, FOB value of export in free foreign exchange 50 crore, market price of export in free foreign exchange 30 crores of rupees. As per the Appendix 3B of the Foreign Trade Policy 2023, reward for export of safety valves to USA and UK is 3%. Find the duty credit scrip under the remission of duties and taxes on exported products, namely RODTEPS scheme, which is available to Yes Private Limited. What is the reward amount under the particular example? Simple, my dear. Look here, in the given example, you have FOB value of export how much? 50 crores. Keep in your hand. Market value of export how much of that product? 30 crores. On the market value, apply 1.5 times. 1.5 times of 30 crores equal to 45 crores. 45 crores or 50 crores among the two, whichever is less. Which is lesser? 45 crores. On such 45 crores, apply duty credit scrip rate. What rate is given here? 3% is equal to how much? Duty credit scrip. Tell me please, quickly, fast. Excellent. 1 crore 35 lakhs. Name me 1.35 crores. Answer is in front of you. Excellent. Questions are going to come in the exam like this. On the remission of duties and taxes on exported product. Now please come back. What are the sectors which is qualified for particular in the given case? Eligible for this particular remission of duties and taxes on exported product. The eligible sectors. Employment oriented sectors like marine, agriculture, leather, gems and jewelry, etc. are covered under this scheme. Other sectors like automobile, plastics, electrical and electronics, machinery, etc. are also get supported under this particular scheme. The entire value chain of textile also get covered under the remission of duties and taxes on exported product, or ROSCTL, namely the remission of duties on particular textile sector qualify for this particular scheme. Similar to that, RODTEP is nothing but ROSCTL for the textile products. So I refer so far what are the schemes under the export promotion schemes. Already refer to you duty exemption schemes. Under that, advance authorization scheme followed by the duty free import authorization scheme. Now I refer under the duty remission schemes, duty drawback schemes followed by remission of duties and taxes on exported product schemes. I refer to you. Further referring to you here, my dear friends. EPCG scheme, export promotion capital goods scheme, is as follows. One by one I am presenting here. Now presenting in front of you, my dear sir, export promotion capital goods scheme, EPCG scheme. What basically it is? Already we covered. Advance authorization scheme, where the exporter allowed to import the goods, which is input goods, to manufacture in India and finished goods to export. On account of import of that particular inputs, not liable to pay import duty, the benefit what is generally given to exporters after export, which is given in advance to the exporter at the time of import of raw material itself. Therefore, advance authorization, which is for input goods. Similar benefit also be granted to the exporters who are exporting the finished goods. For exporting the finished goods after manufacture in India, then to manufacture the goods in India, the exporter required capital goods. Such a capital goods can be imported without payment of import duty? Yes. If EPCG is granted to you, that license is granted to you, you are allowed to import capital goods even without payment of import duty. But such import of capital goods under the EPCG scheme has actual user condition. That imported capital goods you are not allowed to sell unless you redeem export obligation on such import of capital goods, because the import of capital goods under the EPCG scheme covers actual user condition. How to understand this? I will explain to you. There in your material, but I am explaining in my own way of presentation. Referring here, my dear sir, let us say in India, Mrs. Baba Limited is a manufacturer located in New Delhi for manufacturing of the finished product. Baba Limited, manufacturer of finished product. For manufacturing finished product, he requires the capital goods. He want to import. From, let us say, Mrs. S Limited of Singapore. Value of capital goods. Value of capital goods. CG I used to call. Value of capital goods. CG. Let us say, which is 100 lakh. Customs duty is levying on such import, let us say 20 lakhs. Custom duty levying on such import is 20 lakhs. Now, Baba Limited says, Department of Custom, DGFT, Division of Fine Trade, I am the exporter. I am regularly manufacturing the finished goods. Regularly, I am manufacturing my finished product. And my finished products, I used to export my finished product. Regularly, I am manufacturing and exporting. My finished products, I am exporting. FP, I am exporting. I am exporter. To outside India. Error of foreign currency. I importing these capital goods to manufacture the finished goods. That finished goods I am going to export. Please permit me to import such a capital goods without payment of this duty. Department, DGFT, granted the permission. Yes, you are permitted to import the goods without payment of import duty, but ensure that capital goods should be used in the manufacture of the finished goods, and that finished goods ensure that to export. We are going to prescribe certain time period here to export, and export obligations we are going to impose on you. You have to fulfill that. Otherwise, default of export obligation, you are liable to pay this duty along with the interest. Baba Limited, no sir, I definitely will fulfill export obligation. Please permit me to import the goods under the EPCC scheme. Now here, look here, Director General of Foreign Trade, DGFT, where Regional Authority, DGFT, Regional Authority, granted to them EPCG license. License issued. Sir, if the license has been issued, what is the time period within which from the date of issue of license you have to import the goods? Means this import of the goods within 24 months. Within 24 months, import the goods from the date of issue of EPCG license. That means the EPCG license is valid for 24 months to import the capital goods without payment of duty. That means the duty, how much you saved here? The 20 lakhs duty not going to pay. Therefore, it is known as duty saved is equal to 20 lakhs. Within 24 months of issue of EPCG, you have to import the goods. I imported, sir, within that 24 months, sir. Then you have to manufacture the finished product using that capital goods. I am manufacturing, sir. And manufactured finished goods, you have to export. Export to outside India. Let us say Mrs. ABC Incorporation of London. You are exporting the goods to ABC Incorporation of London. Export, taken place. Within which period should be export? The export should be within 6 years from the date of issue of license. Export within 6 years of authorization. Authorization means what? Permission. Permission to import capital goods without payment of import duty, which is issued in the name of EPCG, Export Promotion Capital Goods. License has been issued from the period of issue of license within 24 months you import. Yes, imported, sir. Sir, within 24 months if you are not imported, can I revalidate it? Revalidation not possible. Unlike of your advance authorization. In the case of advance authorization, revalidation is there once only. But in this case of EPCG scheme, revalidation not there. Within 24 months you have to import. Otherwise, this license will be invalid. You have to again apply to DGFT. Now, within 6 years from the date of issue of this license, they have to manufacture using such capital goods, and the output finished goods should be exported within 6 years. While exporting, you have to fulfill export obligation. It is not simple export, my dear. That particular exporter should fulfill what? Export obligation. Export obligation in general we call EO. Export obligation should be satisfied. Here there are two types of export obligations we have. There are two types of export obligations. There are two types of export obligation. One is average export obligation. Other one is specified export obligation. Namely, specific export obligation. Specified in the sense specific, instead of specified, I will say specific export obligation. What is specific export obligation? In the case where you imported the capital goods without payment of custom duty under the EPC license, how much duty saved? 20 lakhs. So, specific export obligation is equal to almost all 6 times of the duty saved. Almost all 6 times of duty saved. How much duty saved here? 20 lakhs. Therefore, your FOB value of export, specific export obligation 120 lakh. And at the same time, you also satisfy average export obligation. Average export obligation, nothing but what? The previous year, 3 years, year 1, year 2, year 3, your export. FOB value of export plus deemed export values. For example, here 20 lakhs, here 80 lakhs. For example, only I am telling you, my dear friends, here 50 lakhs. So total 3 years value 150 lakhs divided by 3. Then you will get here 50 lakhs. So average export obligation 50 lakhs. That means you have to fulfill both the export obligations. In short, practically I can say that whichever is higher that you fulfill, the other one automatically fulfill. That means on account of export, your value addition should be meet the requirement of export obligation. Specific export obligation, 6 times of duty saved, that value, as well as average export obligation, that value you have to export. That means amount to whichever is higher value for export, other one you already fulfill. That means in the given which is here 120 lakhs. Therefore, your export within 6 years, FOB value within 6 years, FOB value of export is minimum 120 lakhs within 6 years from the date of authorization. Then only Baba Limited, New Delhi, who is a holder of export this particular EPCC scheme license, he can say, I have redeemed my export obligation. export promotion capital goods license holder, if he satisfied these conditions and did the process, he can declare, yes, I have been redeemed export obligation. What I promised to department when I was import the capital goods under the EPC license, I have fulfilled the export obligation. If you default it, you will able to pay import duty on such duty amount saved along with the interest. Now, there may be cases where the under the foreign trade policy, we used to come across discouraging the imports because it is causing negative impact. Resultantly, Baba Limited, suppose willing to procure the goods, these capital goods, instead of buying from outside India, want to buy in India domestically. Very good. Government, DGFT, encouraging, hey Baba Limited, you purchase the goods locally. Why you are buying from outside India? Unnecessary, our foreign currency is going there. If you do so, locally if you purchase, your export obligation, I will reduce. Specific export obligation is not 6 times of duty amount saved. It is only 4.5 times of duty amount saved. If the duty you are going to pay on account of import, what duty you are going to pay? 20 lakhs, which is saved now because locally you are purchasing. Resultantly, 20 lakhs duty amount saved if it have been not purchased from outside India. That amount multiplied 4.5 times. 4.5 times equal to how much? How much comes, my dear? Quickly, fast, tell me. Yes, my dear friends, tell me. 90 lakhs. So export obligation is, FOP value of export obligation is only 90 lakh. In the case where if the goods has been procured from domestic tariff area, from the domestic tariff area you purchase the goods, then your export specific export is reduced to 90 lakhs. So 90 lakhs specific export obligation. Average export obligation 50 lakhs, which is higher, 90 lakhs. That much you have to export. That means that time is not 120 lakhs. It is sufficient to export 90 lakh within 6 years from the date of granting of export promotion capital goods license to you. From the date of authorization, within 6 years you are exporting. Validity time period of EPCC 24 months. Whether you purchase from outside India or locally you purchase, 24 months within which you have to purchase. No further extension of time period is the way in which the particular EPCC scheme works here. Furthermore, government encouraging, hey Mr. Baba Limited, if you are import the goods or locally purchase, as the case may be, if you are manufacturing with greater attention and care and exporting, if you are exporting, the exports are expedite. 6 years time period is there, but within 1 year, within 2 years, you are exporting major amount of export obligation. What is a major amount of export obligation? Major amount of export obligation in the given case is if we export 75% or more, 75% or more of your specific export obligation within half of the maximum period of 6 years. Half of the period means within 3 years from the date of authorization. If we export obligation, specific export obligation 75% and above, which is going to be cover 100% of your average export obligation, sufficient. The balance export requirement not required. We are going to be redeem your export obligation. Whether you export the balance export or not is up to you. Sir, what is it, sir? How to understand? Explaining with the help of simplified example. Here, in the given case, assume a scenario. You take this particular specific export obligation where the goods has been imported from outside India, which is 120 lakhs. On 120 lakhs, 75%, apply 75%. How much comes, my dear? Huh? 90 lakhs. This 90 lakhs, if we export, FOB value of export 90 lakhs, which is 75% of your 120 lakhs. In that case, this export taking place within which period of time? Within 3 years from the date of authorization. Then you have been working so hard, day and night you are working in your factory to produce a finished product, and you are going to be export well in advance. That means time value of money is there. No, instead of getting 1 rupee today, if I get tomorrow 2 rupees, same value. If I get 2 rupees today, means what? A greater value. Therefore, time value of money concept is used. Thereby the government DGFT said, hey Mr. Baba Limited, if you export your specific export obligation 75% and above within less than 3 years time period, then that amount of export obligation covering entire 100% of average export obligation, you are very good by. The rest of the export obligation not required to be fulfilled. We are going to be considered you have been fulfilled the export obligation. Thereafter, you are entitled to sell that capital goods in India to any person to whom you like, because actual user condition has been completed. What I imported without payment of import duty and I fulfill the export obligation, actual user condition fulfilled. After that, that capital goods I can sell off in India. There I am liable to only GST under the GST provisions. This is what EPC scheme. Now I am bringing to a notice EOUs, EHTP, BTP, STP, like that. 100% export oriented unit scheme. Very simple. It is there in your material. Still I am going to be present with the help of my own presentation is as follows. Are you catching the points, my dear sir? Wantedly, I am writing on the board by presenting point by point, step by step, how the flow takes place. Instead of showing directly on particular soft copy of material, I am using the hard board and presenting in a simplified manner. People feel that foreign trade policy is so difficult, leave it, skip it. Sorry, it is a lollipop, my dear sir, if you understand. Very, very simple. Once you understand, you can able to have the broader sense of understanding the subject also. So, foreign trade policy is nothing but advanced concept of the customs law. So, now please come back. Referring here, the concept of EOUs, 100% export oriented units. 100% export oriented units. How can you get EOU status? If I say Mrs. Bheem Limited. Mrs. Bheem Limited is in, let us say in Hyderabad. Is EOU? Is EOU? How can you say EOU? What criteria they should satisfy? There is a concept. There is a concept for a kind consideration. They fulfill a concept called A minus B greater than 0. They should fulfill this concept. What is A? Is our export. What is the B? Nothing but import. That means export should be more than our import. Such a concept they should fulfill in a block of 5 years. Not every year, in a block of 5 years, they should fulfill this obligation. Then only the license of EOU. EOU, which is export one unit, which consists of hardware technology park, biotechnology park, software technology park. Like that, there are so many EOUs we have. Now, what is the benefit for them? EOU license holders, if they import goods nil duty. They export. If they export, then no incentive. Why no incentive? When you import, no duty. When you import, no duty. When you export, you are not eligible to any claim of incentives because incentive already you got it. Suppose what happened if anybody supplied the goods to them in India? That point comes into picture. I am presenting here, sir. In case where here, let us say, Mrs. Bharat, Bharat Limited. Bharat Limited is Chennai unit, domestic tariff area. If they supply the goods to them, supplied goods, that means they procure the goods indigenously. In that case, what happened? This Bharat Limited is a supplier of the goods to EOU. They are liable to pay. IGST will be levied. IGST will apply. However, this IGST what they paid can claim refund by Bharat Limited being a deemed exporter, or EOU unit can claim the refund. If this Bharat Limited want to claim refund, EOU unit Bhim Limited should give in underwriting saying that I have not claimed the IGST as input tax credit, I am not going to claim the refund. Refund can be claimed by Bharat Limited. Bharat Limited should get a certification from the Bhim Limited jurisdictional officer of GST. Yes, so and so company received the goods from so and so company. Like that, if the information, the proof they have, they can apply for the refund. Refund will be given to them, provided the recipient should not avail the refund. Either one can claim refund. Therefore, here it is called as, this process is called as, here they are called as deemed exporters. Deemed exporter also will get the benefit of this IGST, provided if the exporter not claiming the refund, not claiming the input tax credit. So I covered here EOU concept. I too covered here deemed export concept. Like that, what is the supplies called as deemed export? What are the supplies are called as deemed exports? Supply goods to EOUs, deemed export. Supply the goods to the holder of advance authorization, or supply the capital goods to the holder of the export promotion capital goods scheme license holder, EPCG license holders. To them, if capital goods supplied indigenously in India, the supplier is called as a deemed exporter. So, under the export promotion schemes, EOU schemes I covered, deemed export benefits has been covered. Deemed export benefit is there in section 147 of the CGST Act, where the supply taken place, IGST levied, the IGST will be levied, it can be claimed the refund by the deemed exporter, provided the recipient not claiming the input tax credit, the recipient not claiming the refund of the same. Now, finally we have special economic zone. Finally, we are having now special economic zone. What is the special economic zone? How we should understand that? I'll also be presenting here. Sir, special economic zone, whenever you refer, it is none other than separate island within the territory of India. That means to say that the SEZ units are governed under the SEZ Act, not falls under the foreign trade policy. It is not going to come under the Foreign Trade Development Regulation Act 1992. It is not come under the purview of the Union Ministry of Commerce and Industry. It is not going to be come under the purview of the Directorate General of Foreign Trade. It is coming under the CBIC, under the Ministry of Finance. But the SEZ units are the units generating foreign currency. Foreign trade policy, when I am referring, without referring to the SEZ, is incomplete. What I told you in the first lecture of mine on FTP. 2023. Now I am presenting to conclude the FTP by inviting the attention on the part of the special economic zone units. Special economic zone. Here there are special economic zone units. How can you say the units? See, a designated area. This area. Here there is a entry. Here there is a exit. Entry, exit. Here there are so many companies are there. Here one company, A Limited. Here one more company, B Limited. Here one more company, C Limited. Like that, there are so many companies are here. These are the unit of SEZ. And here one more point is there. What is that? SEZ developers. Who are they? They laying the road. A road and lighting, then water, pipelines. Here further the electricity, lighting is there, electricity, thereafter water, sewage, let us say sewage facility. These AC developers are developing the infrastructure developers. Now, if I supply the goods to unit of SEZ developers here from DTA, domestic tariff area, let us say RAM Limited supplied goods, it is called as export, and the DT unit should submit shipping bill. Export means what? Shipping bill should submit. And this supply to RAM Limited called as zero rate. RAM Limited can ask for refund of IGST. Yes. So export of goods which includes zero rated supply. Zero rated supply includes supply to SEZ units and developers. Zero rated supply includes supply to units of SEZ. We already referred under section 54 of the CGST Act. So supply to SEZ units and developers called as zero rated supply. Shipping bill should submit. There in the SEZ zone, customs officer sitting the taking care of the SEZ zone and accepting the shipping bill to permit for receiving the goods. If they supply the goods, supplied goods to whom? To, let us say, Mrs. Hanu Limited. Then in that case, this Hanu Limited is called what? He is an importer. Required to submit bill of entry to pay import duty. Who liable to pay import duty? Hanu Limited liable to pay duty. So here they are liable to pay import duty. Import duty paid by Mrs. Hanu Limited, not by the unit of SEZ. That means if the supply made by SEZ unit or supply received by SEZ unit, neither way SEZ unit or developers are liable for any tax or duties, because this particular area is treated as separate island within the territory of India. That's why. Now, sir, the unit of SEZ is eligible to obtain remission of duties and taxes on exported product. Yes, see, remission of duties, taxes on exported products is eligible. They are eligible. They can apply for the want of that after their export. What they can do with that? Because there is no duty they are liable to pay, neither their inward supply nor their outward supply. Here only the unit of SEZ says, I am going to be sell that RODTEPS to others to encash the payment is a helping hand to the SEZ units. Then the DGFT said, yes, your claim is justifiable. You are the hero of the owner of the foreign currency. We will grant to you remission of duties and tax and export product. You can encash by selling it. Is the benefits are granted to the units of SEZ developers. So, with this, I can say that, my dear friends, the foreign trade policy 2023, which is applicable to your forthcoming exam of December 2023 onwards, is well applicable. I have covered extensive manner all the export incentives. First and foremost, I covered status holders certificates star 1 to star 5 export, followed by duty exemption schemes, wherein I covered advance authorization scheme, followed by duty free import authorization scheme. Thereafter, I covered duty remission schemes, one of the export incentive, under that duty drawback scheme, under that remission of duties and taxes and export product I covered. Thereafter, I covered under the export promotion schemes, export promotion capital goods EPCG certification holders allowed to import the capital goods without payment of import duty I covered. Thereafter, I too covered by referring EO units, ESTPs, BTPs, STPs, followed by deemed exports I covered. Thereafter, I concluded this foreign trade policy by inviting the attention on the part of special economic zone unit and developers. With this, the genuine indirect tax laws and practices applicable for your final level of CMA or CA, CS professionals, as the case may be, concluded.